you got to remember, we've been working hard with the U.S. banks and the regulators preparing for these types of scenarios. We put worst case, significantly worst case, severe worst case into the annual CCAR process. And if you look at the losses that we actually just incurred in this first quarter in relation to the total losses that are expected in that CCAR, you would see that Wells Fargo and JP Morgan experienced about 15%, only 15% of the total losses that are incorporated into those stress test environments. And even after going through and losing all of that money, they still would have excess capital. Wells Fargo would have $62 billion left over, and you would have JP Morgan with $42 billion of excess capital. So they would be well capitalized. They would take their worst case scenarios, and you could still lop on tens of billions of dollars, and we're only 15% into the very worst case scenario they can imagine. So while the numbers are big, they're really percentage-wise in relation to what's been embedded in those models still very manageable.
What about the smaller and regional players? I mean, do you think we're going to see a situation here where there's more consolidation in the sector if a few can't survive?
So there's been a kind of a perception that the smaller banks in the United States have been under pressure as we've gone through this. It's really been much different. The smaller banks have been much more profitable. The regulation that the big banks have had to live with has put a pretty significant burden. And the cost of the technology that the smaller community banks need is actually pretty digestible and manageable. So the small banks and community banks, as well as the regional banks, for the most part, are well positioned and ready to interact and engage with their customers, just like what you're hearing from the big banks. So the regulation has rolled downward. It's gotten tighter on the smaller banks. It's prepared them better. So what we're seeing when we talk to community banks around the country is that they are out there taking care of their customers, making sure their employees are healthy, and they have the capital and the resources. And the big thing that happened in the releases today that nobody's talking about is deposits went up 20%. So the deposit growth creates a huge liquidity factor, which is really the biggest thing for banks. So when we start taking the health check, liquidity was way off the charts positive. Capital, they were able to hit the pass mark on what they were able to do earning-wise and capital-wise. And the tangible book value was pretty stable. And so for shareholders, the dividend seems sustainable at this point. And the losses are, going to be high, but they're going to be well within the stress test loss parameters.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.